Assalamu alaikum and welcome to the third lecture for P1 online classes for June 2018 examination. I'm Kashif Kamran, your tutor. Now, towards the end of the last class, we were discussing the stakeholders. So let's do a quick recap of stakeholders, and we are left with some more discussion on stakeholder before starting off with the next topic. This week classes today and tomorrow would again build up the knowledge, and from the next week we'll be starting on with the past papers of the topics we'll be doing today and tomorrow and in the previous two classes. Okay, now towards stakeholders, just 1 minute. Okay, I'm resuming again from the discussion of stakeholders. There was just a 5 minutes pause for Sabika to join in. Please ensure the participants that you join at least 5 minutes before the start of the class for the class to start on time. That is very essential, right? If the class is starting at 9, you should be in the webinar at 8:55 so that it should start at 9 rather than at 9 you come into a panic mode and think about where is the link, how to join in, etc. Okay, let's start back. And let's start with the discussion of stakeholder we were doing into the class lastly. Now, in terms of our discussion on stakeholder, let's do a recap. We went into the definition that stakeholder is any group or individual who can affect or be affected by achievement of the organization objective. Then we went into the definition of a stakeholder claim, that a claim is something a stakeholder wants from an organization. And then we looked at this list of claims of stakeholder. Then we went into the Mendelow metrics, which was a more important discussion, that as per the Mendelow metrics, there are 4 types of stakeholder: minimal efforts, keep informed, keep satisfied, and key players. The last two, keep satisfied and key players, are very important because they have high power. So if you are prioritizing your stakeholder, the most important stakeholder would be key player, then keep satisfied, then keep informed, and then minimal efforts. Then we went down into some discussions about how a stakeholder can change category, and we did many discussions on employees, the different level of employees from operational to strategic, and how things would vary down. We had a discussion on power, we had a discussion on interest even. We did came down with conclusion that interest could be few and many, and power is by default like a government, and power can be through your action like a pressure group. The pressure group has a power to do negative publicity of the company. Then we went down to the session exercise, and in the session exercise we did the exercise that how would we be identifying the CEOs, external auditors, public and operational employees. Now let's start with the agenda for the class today. How to categorize the stakeholders? There are many theories which suggest that stakeholders can be categorized into different classes. I hope you must remember from your initial papers of ACCA that the most simple categories of stakeholders are internal stakeholders and external stakeholders. But obviously P1 is not discussing internal and external, because to know who is an internal stakeholder and who is an external stakeholder is just to know who is inside the company and who is outside the company. But internal and external does not tell us who is important and who is unimportant. So in the F1 paper, we used to do the internal stakeholders and external stakeholders. That was just who is inside and who's outside. But that does not justify who is important and who is unimportant. But this category by Evan Freeman is telling us who is important and who is unimportant, who is narrow, who is wide. Narrow. Narrow means what? Narrow means someone who is very much active. Narrow means someone who is very much focused. Narrow means someone who is very primary. Wide means someone who is passive. Wide means someone who is not, who is secondary and who is not much, not focused. So for a company, who are narrow stakeholders? The shareholders. See, the shareholders are so active, they're focused, they're primary. The management is so active, focused, primary. Employees are so active stakeholders. They are in the day-to-day running of the company. Suppliers, they're so active. Customers, they're so active. The wide community, the public is passive. Government, government is the one which sits in the parliament, right? The government is passive. The regulator is active. If you want to differentiate, the government is passive, right? The government is the one who sits in the parliament. The customer, and if you want to add here, the regulator would be narrow. So the regulator would be narrow. The trade union would be narrow. So in the exam paper, if a question comes in, you need to identify from a case whether the stakeholder mention is narrow or wide. So narrow means the one who is active, the one who is focused, and the one who is primary. And the passive, secondary, not focused is the wide category of stakeholder. So the company would be more concerned for narrow stakeholders, because the narrow are the one who are much important. Now this category given by Evan Freeman, the theorist, will now repeat in the other theorist. Once you know Evan Freeman, you know many categories for P1. Let's do the second one. Clarkson. Clarkson says primary and secondary. Now you know narrow and wide, so you know primary and secondary. Customers are primary, suppliers are primary, provider of finance, bank. Bank is primary. Management is primary, employees are primary, government is secondary, society is secondary. So if you know narrow, you know primary. If you know wide, you know secondary. That's only the change of the theorist, Clarkson. So Clarkson says a stakeholder can be primary, a stakeholder can be secondary. Third category, Mahoney. Mahoney says stakeholder can be active, stakeholder can be passive. So that's again coming from the Evan Freeman's. Active management is an active stakeholder, employees, regulators, major shareholders, environmental pressure group. They are active. Active in what? Active in terms of their involvement with the company. Involvement. They are so active in their involvement. And passive in terms of their involvement. So government is not very much involved, right? Regulator is involved. Small shareholder is not involved. The major shareholder is involved. Pressure groups, they're so much involved, right? They are so much active. They are waiting for a bad news to come from a company. And the moment they get the bad news, they just escalate that on the media. So the pressure group is waiting for things to come out of the company, bad news to come out of the company. So active, passive in terms of their involvement. Voluntary and involuntary stakeholders. Now we know voluntary means what? Voluntary means something which is optional, and involuntary means something which is without option. Without option. Voluntary means something which has choice. See, the stakeholders coming under voluntary, they have choice. Shareholder have a choice, right? He is a stakeholder by choice. He bought your shares. So he became your shareholder. If he sells shares, he will not be your shareholder. So he has a choice, right? He can buy shares, he can sell shares. He has a choice. Manager, employees, they can join your company, they can resign from your company. They have a choice. Customer can buy your product, customer cannot buy your product. He has a choice. Supplier can supply you, supplier cannot supply you. So see, all these stakeholders have choices. The choices makes them powerful. The choices gives them power because they have a choice. The shareholder can buy and sell. The manager can work and resign. The customer can buy or not buy. The supplier can supply or not supply. So that means the voluntary stakeholders are more important stakeholder because the choice they have, the choice is giving them the power. The choice is giving them the bargaining power. The involuntary stakeholders are by default. The involuntary stakeholders are by default. They have no choice. They have not become your stakeholder by choice. The voluntary have become stakeholder by choice. Environment. Environment does not have choice. Environment means a ecological environment. Competitors. Competitors have no choice. If they are doing business with you, they have to do business with you. Local community. The community that is around the business. If you open your factory in some area, that area becomes your local community. If you open your head office in a certain area, that certain area becomes your local community. That is the near community, right? So the local community, wherever you start doing your business, the near community becomes your local community, whether they like it or dislike it. Competitor, whether he likes you or dislikes you, he has to do business with you. Environment, the planet, whether we pollute planet or we don't pollute planet, the planet continues to support the business. Right? So the involuntary stakeholders have no choice, right? Voluntary stakeholders have choice, and the choice gives them power. Right? So that's the end of this topic, stakeholder. Again, today and tomorrow, we're building the exercise of knowledge, and next week, we'll start with exam papers, see where we can end today and tomorrow, and how many topics we have to start practicing corporate governance from the next week. I'll be giving you exam papers tomorrow to practice, and we'll be solving them into the next week classes. Okay, now that's the end of the stakeholder topic. We are now starting with the third topic, which is agency relationship. Agency relationship is another important area of P1 exams, not very significantly important, but yes, it is partially important. We have seen questions on this topic initially in P1 exams. An examiner do rarely ask questions on agency relationship across the P1 exams. Now, obviously, the June 18 exam is the last exam sitting for P1. So let's see how the examiner prepares a question for June 18 exams. But yes, agency relationship has been a focal area of the past exam papers. Now, you must be knowing agency from your F4 knowledge, because that's exactly what you do in F4 for agency. Agency relationship. Agency relationship for P1 for corporate governance is a relationship between a principal where the principal is the shareholder and the agent, which is the director. The agency relationship in P1 in corporate governance is very narrow. It's not discussing any other agency relationship. It's only discussing a very important relationship that is between the shareholder and a director, that is between the principal and the agent. And what we need to discuss with terms of this agency relationship, that is between the principal and the agent, is the three things: the agent responsibility, the agent accountability, and the agent alignment of interest. The agent is responsible, right, towards principal. We'll see the answer on the next slide. The agent is accountable to the shareholder. How? Again, the answer will come on the next slide. And the agent, being the director, should have an alignment of interest with the principal. Let's see each one of them in order. Agent responsibility. Agent responsibility. What is the agent responsible for? This answer is not coming from corporate governance. This answer is coming from the Companies Act. The agent is responsible to work in the best interest of the shareholder. And you know from your F4 paper that this is something legally defined. This is known as the fiduciary responsibility. Right, so what is the agent responsible for? The agent is responsible to work in the best interest of the shareholder. So who is defining that? The law is defining that. Now, where is corporate governance? The corporate governance comes after this. How to work in the best interest of shareholder? That is a big difference between governance and law. Law tells us what to do. Governance tells us how to do. Governance is best practices, right? How to do governance. It is coming from the governance. And governance is what? Governance is a best practice of how to do something. So what is law? Law is box ticking, right? What to do. So we normally say that law is a box ticking. But governance is best practices of how to do something. Now, if an agent, if a director wants to work in the best interest of the shareholder, how would he work in the best interest of the shareholder? Boardroom culture. If the agent wants to work in the best interest of the shareholder, the boardroom is a very important place, because we know boardroom is a place where decisions are taken for the best interest of the shareholder. And if a wrong decision is taken, that can make a company loss making rather than a company profit making. Boardroom. Try to understand the importance of a boardroom in a company. And boardroom is such an important place in a company where decisions are taken about the future and about the future wealth of the shareholders. What should be in the boardroom? Number one, disciplined people. Disciplined people means director. What is in the boardroom? Directors. Disciplined. Disciplined in terms of what? Disciplined in terms of skills. Disciplined in terms of knowledge. Disciplined in terms of experience. Competence. Competence. They should be disciplined. The director should be qualified. The director should be experienced. The director should have skills. The director should have knowledge. So the more experienced they are, the good they are. The more knowledgeable they are, the good they are, because they have to take decisions. So disciplined people will lead to a good decision. Disciplined people, then disciplined thoughts. Thought means ideas. Thought means brainstorming. We know in a board meeting, the board meeting is all about brainstorming. In a board meeting, we share ideas. One director will share one idea, the second director will share another idea, the third director will share another idea. Disciplined thoughts. And the thought leads to actions. The actions means the decision. So after the brainstorming comes the action. The action is the decision. The action is what to do now. So see, a boardroom is such an important place where the future wealth of the shareholder is decided. How it is decided? By the people. The people should be skilled, competent, and experienced. Thoughts, brainstorming, ideas, and finally, one of the idea is selected as a decision to work in the best interest for shareholders. So the law is telling us what is the agent responsible for, right? And the corporate governance is telling us how to work in the best interest of shareholder. Is that clear with the attendees? Agent responsibility. I'm starting off with agent accountability. Agent accountability. We know the director being the agent. The director is accountable to shareholder, right? Directors are appointed by the shareholders, right? So that means the director can be removed by the shareholder. So shareholder appoints the director, shareholder can remove the director if he's not working in the best interest of the shareholder. So directors are ultimately accountable to shareholders because directors are custodian or directors are steward of the shareholder or directors are the agent of the shareholders. Now, in terms of corporate governance, there is another authority which can make directors accountable. That is non-executive directors. Non-executive directors. The non-executive directors can also make directors accountable. And the non-executive directors can keep a check on the directors. Check on the directors. And the non-executive directors can give a feedback to the shareholder. Feedback to the shareholder. So the NEDs keeps a check on the directors and they can give a feedback to the shareholder. The shareholder on the basis of the feedback can decide whether to appoint the directors or to remove the directors. So NEDs plays a very crucial part, right? We know in corporate governance, as we move into the syllabus further, in our syllabus, we have 4 committees of non-executive directors. I hope you know that from your prior studies of ACCA: audit committee, risk committee, nomination committee, remuneration committee. So all these committees keeps a check on directors and they give feedback to shareholders. And the shareholder can take a decision on the basis of the feedback whether to reappoint the directors or to remove the directors. So agents are accountable, right? They are accountable to shareholder primarily because the shareholder appoints them, but the non-executive director will keep a check on the shareholders, right? So that is agent accountable, agent accountability, agent being answerable, right? Is that clear? Okay, from the agent accountability, let's start the next one, alignment of interest. Now, the agent being the director, the shareholder being the principal, they should have an goal congruence. They should have an alignment of interest. Shareholder, directors. Shareholder wants a return on equity. That is the interest of the shareholder, right? Return on equity. Dividends, return on equity. Director, what is their interest? Remuneration, salary, bonus. Now, corporate governance suggests there should be an alignment of interest. There should be a goal congruence. There should be a goal congruence between the two. How? Corporate governance thinks that the return on equity and remuneration can be aligned if we have something like performance related pay. The remuneration of the directors can be linked with performance because performance is the shareholder interest. Performance is the interest of the shareholder, and pay is the interest of the director. Performance related pay. Now, performance obviously means profits. Performance obviously means sales. Performance obviously means the market share. If the company is becoming successful every year, that is very good for the shareholder, right? And if the company is becoming successful every year, then on the basis of that performance, the remuneration of the director should go up. So this remuneration of the director is based upon what? Is based upon performance. So better the performance, better the pay. So see how corporate governance has aligned the interest of the shareholders with directors. Performance related pay. Right? Is that clear with everyone? The attendees, is that clear? Okay, moving further from this topic then. Agency cost. Now we need to be very critical of agency cost. Agency cost is a cost which the principal incur to monitor or remunerate the activities of an agent. What is an agency cost? It's a cost which a principal incur, the shareholder incur, right, to monitor or remunerate the activities of the agent. Now, what exactly that is? The cost, the principal incur. See the salaries of the directors. Salaries of the director is a cost which the principal is incurring from the profit. You know the operating expenses, right? The operating expenses are deducted from the profit of the company. Shareholder ultimately gets the profit, but the operating cost is the agency cost. The operating cost is what the principal incur that is deducted from the profit of the principal. The salaries of the directors, the salaries of the auditor. Auditor is also an agent of the shareholder. And cut short operating expenses, all the operating expenses. So the operating expenses is what the principal incur, right? I hope everyone knows that, right? The sales, the operating expense, and the profit before tax. I'm not taking the cost of goods sold and the GP. Cut short formula, sales, and from the sales we minus the operating expense, we get down to the profit before tax. Or from the gross profit, we minus the operating expense, we get down to profit before tax. So agency cost is a cost which a principal incur to monitor or remunerate the activities of an agent. So you have to remunerate the agent, right? The agent cannot work without remuneration. Monitor, see how much cost you pay, to the auditor. Okay, the voice issue, right? It has come back now. Other agency relationship. There is an article again, non-corporate corporate governance, which is written on other agency relationship. Non-corporate means this word here, non-corporate. Non-corporate means non-listed companies. Non-corporate means non-profit organizations. Non-profit organizations. Non-corporate means public sector. Non-corporate means charities, NGOs. Non-corporate corporate governance. Just one correction. Non-corporate corporate governance. Only the four. Non-corporate corporate governance includes the four non-profit organizations, public sector, charities, NGOs. Non-corporate. Who is non-corporate? The non-corporate are the one whose objective is to work for welfare, not profit. Non-corporate, corporate governance. So how corporate governance is applied to such companies? How corporate governance is applied to a non-profit organization? How corporate governance is applied to public sector organizations? How corporate governance is applied to charities? How corporate governance is applied to NGOs? So the examiner has written an article on that, non-corporate corporate governance. Now, I'll be telling you more about non-corporate after 5 minutes. Let's first complete the agency relationship between non-corporate we have in our syllabus, and then I'll give you a better definition of non-corporate because you need to understand it very perfectly. It's a very major part of your syllabus. Public sector organization. Now we know the public sector is the one which is owned by the government, public sector, schools, hospitals, colleges, military, police, transport, public sector organization, the one which is owned by the government, public sector, government, taxpayer, officer running the organization. Now, we need to be very clear. In a public sector organization, the government, the taxpayer, and the officers who runs the organization. For example, in Pakistan, there are so many public sector organizations. There are so many hospitals in Pakistan which are under public sector. For example, the Jinnah Hospital. For example, the civil hospital, the police department, the Pakistan Railway. The Pakistan Railway is under the public sector, right? The public sector is the one which is owned by the government. We need to be very critical. Is the taxpayer the principal of a public sector organization, or is government the principal of the public sector organization? What would you rate as? If I ask you this question, is the taxpayer the principal of a public sector organization, or is the government the principal of a public sector organization? Which one would you justify as the principal? Which one will you justify as principal? Taxpayer. Okay, that's perfect. What about the other attendees? Sabika, what would you identify as a principal, government, or a taxpayer? Okay, taxpayer, right? Taxpayer is the ultimate principal. My question was, in a public sector organization, who is the principal, the taxpayer or the government? The taxpayer, right? The taxpayer is the principal. Taxpayer is the principal. B. Government is the agent. A. Of whom? The taxpayer. The taxpayer can make government accountable. The government is the custodian of the taxpayer. The government is accountable to the taxpayer. So taxpayer is the principal. The government is the agent in a public sector organization. But see the officers running the company. The officers does not know about the taxpayer. The officer do know about the government. The salaries are paid by the government, right? The salaries are paid by the government. So officers are the agents. A, but officers are agent to whom? Government. Government becomes the P. So government at one time is an agent, government at another time is a principal. For a taxpayer, the government is the agent, right? And the taxpayer is the principal. But for the officers running the organization, the officers are the agent. Because the government paid the salary, the government becomes the principal for the officers. Right? So in a public sector organization, the government at one time is an agent, and on the other time, the government is also the principal. But the ultimate principal remains the taxpayer, because it's the money of the taxpayer which is needed to run the public sector organizations. Charities, much more simple. In charity, there is a donor who give donations, and in a charity, there is the people responsible to spend the charity. That's very clear. The donor is the principal who give donations, and those responsible to spend charity, that is they are the agents. Now, as a student for P1, you should know the relationship of a government and a taxpayer, and all of you picked that very effectively. Donor in a charity is obviously the principal. That's more simplistic, and those responsible to spend charity is the agent. Okay, now let's do one exercise on this non-corporate corporate governance, and please try to understand it as clearly as possible. Non-corporate corporate governance, right? Okay, I'm typing something on the Word file. Keep your concentration. Non-corporate corporate governance. I'm not just explaining this topic from the view of agency. I'm explaining this topic in the context of P1 broadly, that how important this is for P1 exams. Okay, when we look at non-corporate, what does that mean basically, right? Non-corporate means the charities, the public sector organization, the NGOs, the non-profit organizations, etc. Now, we know that in terms of non-corporate, the ultimate objective is welfare, not profit seeking, right? When we talk about the governance, I hope you remember governance is a system by which companies are directed and controlled, right? Now, if we look at this definition, governance is a system by which companies are directed and controlled. And we apply this to a non-corporate companies. Companies, right? There are so many examples of companies. Companies can be listed, company can be non-listed, company can be non-corporate companies. And if we apply governance to a non-corporate, what does it look like? Example, it's a system by which companies are directed and controlled. When you look at control versus non-corporate, controls are generally weaker. Controls are generally weaker in non-corporate, right? Is that true? Controls are generally weaker in non-corporate organizations. Is that true? Asad and Sabika, is that true? Controls are generally weaker in non-corporate organizations. Yes. Reason? Let's find the reason. Controls are generally weaker in non-corporate organizations. The reason is that they can't spend a lot on internal control systems. They can't afford internal audit department, and for them the cost of control outweigh the benefits. So for these reasons, they don't have controls in place. They do have controls in place, but controls are not very effective because they do think that the cost of the control is very heavier, and the cost and the benefit they're getting from controls is not much, being a non-corporate. Secondly, when you look at the part of the direction for versus a non-corporate organization. Now, direction comes from strategic management, and in a non-corporate, yes, agree, Sabika. In the end, they're not profit seeking, so they're not much worried about controls. Okay, then the next thing, direction versus a non-corporate governance. Direction comes from strategic management, right? And in a non-corporate organization, strategic management is not much experienced as compared to a listed company, not much competent as compared to a listed company. They're not much skilled as compared to a listed company, and normally lacks very effective direction. If you compare a direction of a listed company with a non-corporate organization, obviously listed company would be taking precedence in that, because listed company has so capable directors. So there can be issues, right? If an exam question comes and a question asks you issues in governance of non-corporate, you should have some sense of that. The issues in governance. So governance issues can be in direction. Governance issues can be in controls. So if you're comparing a listed company with an NGO, obviously you're comparing a listed company with an NGO on the basis of controls. You're comparing a listed company with an NGO on the basis of directions. And obviously you have to conclude that a listed company is far better in terms of its structure, in terms of its control, in terms of its direction, right? The second thing you need to understand now, when we talk about, is everyone clear till this point in time? I'm moving to the next page. Is anyone still taking notes from this page or taking things down from this page? Okay, fine. Okay, let's get to the next page. Now try to understand another thing. When you look at these companies types in P1, there are so many questions in the past paper, right, which have questions in past papers like this. Number one, differentiate between listed company and a family business. Differentiate between a charity and a listed company. Examiner is very fond of asking such questions in P1, right? When he asks students to differentiate between a family business and a listed company, that means examiner expects the student to know the characteristics of a family business with a listed company or with a charity and a listed company, right? Charity and a listed company. So we need to understand one thing. I'm using a jargon. I hope you can understand that. In P1, there are two, sorry, the first thing we need to understand for P1 is a family business. We know a family business is such a dominating business, right? Particularly when we look at these Asian economies in Pakistan, in India, in Bangladesh, in China, these Asian economies, they have so significant amount of family businesses and even listed family businesses. The family businesses and a listed company, it's not necessarily that a family business is listed. And even though if a family business is listed, there are differences, right, between a family business and a listed company. I'll be sharing a handout with you on family business and listed company, which you will be preparing for next week classes. But you should try to develop a mindset between a family business and a listed company. And the next thing the examiner wants us to know is a charity. So as a student, we should know the characteristics of a family business. We should know a characteristics. We should know characteristics of listed company, and we should know a characteristics of charity. I have my handout on this, which I share in my normal classes. I'll be sharing that with you by tomorrow so that you start preparing it for the next week classes. And you should, it's very natural. You will read it and you will understand it. What's the difference between a family business, listed company, and a charity? But such questions exist in past papers. So you should be very focal of that, right? You should be very clear about the different types of companies which are in P1. So is everyone clear about non-corporate? Non-corporate has so many examples, then you should be very clear about the different types of companies. Okay, now I'll be sharing a handout with you on these differentiations. I'll try my best to share that by tomorrow so that you can prepare that for the next week classes. And secondly, be very realistic about the term non-corporate, right? The term non-corporate used by P1 examiner. Okay, let's go back to the slides. So non-corporate, right? You should be very clear about this. Asad, you want the Word file to be shared with you? Is okay. At the end of the session, I'll save it and put it on the WhatsApp group. The company I work is a family business. So from my experience, it's more laid back, like freewheeling opportunism. Yes, exactly. Agree, Sabika. The family business have their own myths. The family business have their own philosophies. They do have this laid back attitude. They don't, obviously, they're not as professional as a proper listed company. They have their own philosophies. They have their own mindsets. They have their own thought process, which is very much different from a listed company. So if you are working in a family business, you can realize the difference much better once you get the handout. Okay, moving ahead. We are starting with topic 4 now. Topic 4 will change the context. Topic 4 is a very important topic in P1 exams, that is different types of corporate governance regimes. We should know what are different types of corporate governance. We know corporate governance is a system by which companies directed and controlled, but what are different types of corporate governance? You can see this image in front. It shows the American flag and the British flag. These are two different types of corporate governance in the world, the British governance and the US governance. Both are part of your syllabus. British is the major part of your syllabus. The American is just a topic and will exit out of it. When you look at the different types of corporate governance, there are two different types of corporate governance, one known as principles, the other known as rules. And again, the examiner has written an article on it, Corporate Governance Code. Principles and rules. In America, we have a Sarbanes-Oxley Act rules. In UK, we have a combined code. Code means principles. Rule means act. Now, as a student, you need to prepare for your P1 examiner requirement. The P1 examiner wants you to know the difference between principles and rules. You cannot just write in the exam paper that principles is a code and rule is an act. You should know the differences between principles and rules to better understand the different types of corporate governances. Now, let's do an exercise on the differences between principles and rules. Irrespective, principles are in UK and rules are in America. Sarbanes-Oxley Act. Sarbanes-Oxley Act is a very minor part of our syllabus, right? Combined code is the syllabus of P1. Principles or rules. One of the major difference between principles and rules is rules is a comply approach. Principles is a comply or explain approach. Comply or explain approach. See the difference? In a rule, there is no option. There is no option in a rule. It is a comply approach. That means it is a must comply. It is something fixed. Comply. You have no option, right? Comply. You have no option. But in a principle-based approach, you have an option. See the option? Or is the option? That means it's not fixed, it's flexible, right? So rule-based is a fixed approach. Comply, something we know, something we say box ticking. Rules, right? Rules are box ticking. You just have to tick. Have I done this? Yes. Have I done this? Yes. Have I done this? Yes. Comply approach. But in a principle-based approach, you are open, you're flexible. It's not box ticking because comply or explain approach gives you a flexibility. Either you comply with the principle or you don't comply with the principle. If you think you have a better option, you apply the better option. They're flexible. Let's see why. Let's see why they're better. Okay, now when we look at the principle-based approach, which is used in UK and the rest of the world, except for USA. Principle literally means what? Principle means guidelines. Principle means best practices. Principle means guidelines. Principle means best practices. Principle means comply or explain. So guidelines, when they are guidelines, you can comply with them or you cannot comply with them. They're not rules, they're guidelines, best practices. You might like the best practice. If you like it, comply with it. And if you don't like the best practice, or the business think they have a better practice, then you need to explain that. Either you will comply with the best practice as given, and if you think I have a better practice than what is being given as a best practice, you will explain that best practice and you will follow your own practice. So see, they have flexibility. Flexibility in terms of what? Judgment. So the director can exercise judgment. In a rule-based approach, you cannot exercise the judgment, right? In a rule-based approach, you need to stick to the rule, whether you like it or you dislike it. But in a principle-based approach, if you dislike the best practice, you can explain it. So are you understanding the importance of principle-based approach? You have a flexibility. You can take a decision. You can exercise your decisions. If you don't like something, you can explain it and come out of it. In a rule, it's compulsion, right? In a rule, it's binding. So the director can exercise judgments. So principles are guidelines, principles are best practices, principles are comply or explain. You might like it, you might not like it. You have flexibility, you have judgments. Principles are cross jurisdictional. Cross jurisdictional means principles can be applied the world over. Principles can be applied the world over, and that's true. The corporate governance in UK is being followed in the whole world because they are principles, they are best practices, they're not a rule. Rule is only within a country, right? Rule is only within a country. So if Sarbanes-Oxley is in America, it is in America. But principles have no boundaries. Principles have no boundaries. You know your principles as well, right? Being accountants, integrity, objectivity, confidentiality, professional behavior, professional competence. They are also principles, right? They're followed by all accountants, whether they're accountants in Pakistan, in Middle East, in Australia, in America, in Canada, wherever the accountants are, they follow the same principles. So principles have no boundaries, right? Rules have boundaries. Is Asad and Sabika, are you clear on this principle-based approach? Okay, I'm just stopping here. Tomorrow we'll continue with rule-based approach, a better difference between principles and rules. I'll be sharing this Word file with you within the next few hours. And also I'll be sharing a handout on the family business, listed company and a charity with you, which you will be preparing for next week. Tomorrow we have a class, and that would be another class on lecture. Tomorrow I'll give you some past papers for which you will be practicing uh, on them, because I'll be solving those past papers the next week. So next week, hopefully, we'll Okay, the voice was gone again. We are back. It's just a concluding sentence, concluding the class today. We'll meet tomorrow. The times are known, 7 to 8:45. 7 to 8:45 is the time for the class tomorrow. And I'll share the files and share the session notes. Sabika, I'll reconsider your query for change of class times. It's not possible. If you keep missing classes, you will still get the lectures recorded and sent to you. Okay, Allah Hafiz.